and I'm trying to determine, is that industry in a recession? Is it priced for a recession? Versus other ones that might be at risk for a recession, but not priced for it. So I generally view sector by sector, industry by industry, rather than the whole economic picture. So I generally think that we're in more of a malaise going forward. So it's not doom and gloom. But until I see signs that say otherwise, I think we're in a little bit of a pretty range-bound period in terms of economic performance. And then my guess would be also top-line equity performance, but we'll see.
Lyn Alden, founder of Lyn Alden Investment Strategy, returns to the show once again. We'll be breaking down her outlook on the economy, Fed monetary policy, fiscal dominance, the situation of tariffs on the impact of economic growth, inflation, Bitcoin, and much more. Welcome back to the show, Lyn. Always good to see you.
Thanks for having me. Always happy to be here.
A lot of news to go over since last time you were on the show. I want to start with your fund, EgoDeath Capital, and your investment strategy. And I kind of just start the conversation with your current asset allocation priorities and your breakdown for your market outlook before we get into the details. So walk us through EgoDeath Capital. I understand you've currently raised additional capital, and walk us through the thesis of your current portfolio asset allocation.
Sure. And so I kind of have two different pools of capital that I manage. There's the macro side and there's the venture side. So EgoDeath Capital, we just raised $100 million for Fund 2, which deploys in the venture space. So we lead Series A investment rounds. And our focus is on the Bitcoin space. So there's been kind of billions of dollars raised for the broader crypto ecosystem. Whereas what we focus on is primarily Bitcoin, to some extent stable coins, and basically things that focus on kind of high utility. And so we still perceive a big market for that. That's why I do on the private side. And then on the public side, my strategy continues to focus on the three-pillar portfolio. So one pillar is high quality equities, both US and globally. Another pillar is hard monies, so Bitcoin, precious metals, and you can put commodity producers in that bucket, and then a smaller slice of cash equivalents to protect against volatility and to rebalance into any turbulence that can occur along the way.
Okay, so let's go over these three buckets right now. I think that'll frame the conversation quite well. High quality equities first. Can you break down the sector sort of allocation and preferences over weights?
Sure. So one of my focuses lately is that I think we're seeing a wake up in Latin American equities to some extent. It's never going to be a straight line, but I think we might be past the turning point of them kind of perpetually underperforming U.S. equities in aggregate. I've also been fairly bullish on Chinese equities. But then in the United States, I'm more focused on both growth and value stocks, but ones that tend to focus a little bit more on the service sector. They're generally more protected from tariffs. They're generally more protected from the cyclicality of the economy. And I do think we are in a little bit of a deceleration currently. But whether you look at growth at a reasonable price stocks, including some of the Mag 7, or you look at some of the more value type of equities. So I'm pretty bullish on the financials in the U.S. economy. I think they're relatively well protected from some of the downside scenarios, but they're still inexpensive, unlike some of the highest quality tech stocks that are out there. And so I think there's still a lot of opportunity in equity markets, even though I do think that the top line of the index is kind of stretched at the current time. For the broader side of the portfolio, I think that while I'm still bullish on gold longer term, starting about 3-4 months ago, I got concerned around a consolidation potential. We've been in that consolidation. I think it probably still has room to go. But once we do get to a breakout, I would resume my bullishness on that. And I still continue to be focused on, perhaps not surprisingly, Bitcoin in that hard monies bucket, because while gold is a mature $20 trillion asset, Bitcoin I still think is rapidly growing into the asset that it's going to become. And so as it has exceeded $2 trillion and as it continues to grow and build its network effect and reach corporate and to some degree sovereign adoption, I continue to prioritize that in the portfolio. And cash equivalents, mainly just that's because I'm not bullish on long duration bonds still. I'm not as bearish on them as I was, say, 4 or 5 years ago. But basically, as now we're kind of in a period where you get a lot of volatility in them, still not very high yields. And so I use some cash equivalents as a buffer, but it's not an area that I tend to be prioritizing because the overall backdrop of what I focus on is that because we're in fiscal dominance, things tend to run hotter than a lot of the bears expect. So I've generally been fading some of the arguments to be heavily in cash, even though I don't like to be zero in cash and cash equivalents.
Okay, a few major developments we should note since your last appearance on in February with me. Let's start by talking about the yield curve. The yield curve has continued to steepen. You've highlighted the importance of the inversion of the yield curve as a indicator for future economic growth and or contraction. We have notable economists like Richard Clarida from PIMCO highlighting that his outlook for the 10-year curve is to be steepening, not flattening. First of all, do you agree with the outlook for a steepening yield curve going into the rest of the year? And if so, what are the implications on fixed income allocation and also your cash position?
So I view that as kind of flat to up. So I don't have a strong view of what happens for the next 6 months because we do have a decelerating economic condition, and so that can put potential downward pressure on the longer end. But I do expect that there's more room for cuts, interest rate cuts, than there is for the long end to really go a lot higher or a lot lower. And so to the extent that we get a steeper yield curve, maybe not over the next 6 months, but over the next 18 months or more, I think it'll be a combination of lower short end interest rates and then kind of flattish longer duration rates would be my base case. So that could be 50 basis points lower, could be a 50 or 100 basis points higher. Depends what happens. Anything can happen in the next 18 months on that end. But I think that'll probably be combined with a somewhat lower on the short end of the curve in response to economic deceleration, as well as because by that point probably would have a new Fed chair that, along with the rest of the committee that sets policy, would probably have a more dovish bent compared to what we see now. And as far as my bond outlook, to the extent that I want to have some duration, it's still generally in that 2 to 5 year range, less so in that very long term range. That way, you could potentially, if you get a 2 year treasury, you can potentially participate in some of the cuts that could happen in the years ahead and lock in more of your yield. But I still think that the attractiveness of the long end of the curve is still not particularly high, despite so much underperformance. And while it's suitable for a trade now and then, I still think that there are much better asset classes out there than the long end of the curve. And one of the things we've seen is that, like when the Fed did mildly trim interest rates before pausing again, mortgage rates and other long duration parts of the curve didn't really go down with it. So there's been a lot of recent political drama about how the Fed should be lower in terms of interest rates, and that argument might have some merit to it. But it's important to keep in mind that just because they lower interest rates, there's no guarantee that the long end would behave accordingly, and in some cases it might even go up because if the market perceives that the Fed is not serious about inflation or is too dovish, it could sell off the long end of the curve, including mortgages. And so I still, to the extent that I am in many ways interested in fixed income, I'm more interested in the short end of the curve.
Well, now that Powell has indicated that he's in no hurry to cut interest rates, in fact, he's reiterated that position at this week's FOMC meeting again. Are you still looking at net margin interest expansion for banks, and given that rates, the short end of the curve may not be coming down immediately, and the long end of the curve, like you said, may flatten, so we're not really going to get, a huge margin expansion from the steepening of the yield curve?
I don't think we're really going to get net margin expansion for banks. I think basically they're priced for stagnation for the most part. I tend to prefer the regionals and the super regionals in that regard. And so they got through this obviously very turbulent period with yields selling off and unrealized losses on their balance sheet. Some of the larger super regionals have had to raise capital, so they've been not buying back their shares as aggressively, not raising their dividends as much, kind of retaining earnings. And I think that over the next year or so they'll probably be reaching the end of that phase, and so they could focus more on returning capital to shareholders. There's also potentially more accommodative policies around their supplemental leverage ratios and things like that. So I generally view the banking sector and to some extent the insurance sector as more of a yield play with some growth attached to it. So some earnings growth, some dividend growth. That if you're willing to take the higher volatility is interesting. There's also, I mean, formerly MicroStrategy, they've been kind of shifting. This ties into banks because they've been somewhat shifting their credit profile. And so they've historically been known for issuing convertible bonds, but they're actually their most recent offering is basically almost like a stable coin or almost going after the money market uh, um, pool of
Yeah.
capital. And so they have this new preferred that is intended to trade uh, roughly at a pegged level. They have various mechanisms to maintain it there while paying a yield that exceeds what you get on treasuries currently. They have the ability to adjust the coupons that they pay. They have various mechanisms to kind of maintain that. And so with that, what you get is basically uh, almost like a cash equivalent, but it's backed up by a large pool of Bitcoin. And so I actually find that one of the more interesting introductions, you could say, to the finance sector. And I think that issuance is probably going to get a lot bigger over the next year or so.
I will come back to the Fed in just a minute, but I want to finish off on your equities outlook. So the geopolitical tensions that have heightened in the Middle East since last we spoke, particularly with Iran and Israel, and now the U.S. being directly involved militarily. What implications does that have on your equities outlook? Is that, first of all, a risk to the overall equities indices in some way in the U.S.? And the second part of the question would be, are you playing that by longing defense or overweighting defense stocks?
So I'm personally not because I have a view on it per se, but because it's just not an area of expertise of mine to
Hmm.
focus on the defense sector. So I generally leave that to other investors. One of the things I do is that I have a separate slice for energy producers. To the
Hmm.
extent that I'm in the energy sector, I've been preferring to play it primarily through the equities, through the producers, because oil has been very range bound. So I've been preferring to buy the assets that are trading at pretty low multiples that are profitable at current oil prices that in many cases are paying dividends or buying back shares and have good balance sheets at current oil prices. And basically what that does is that kind of serves as like a perpetual option on Middle East destabilization or anything else that might drive energy prices higher. And in the meantime, it pays me to own it. And so right now, we're generally seeing that at current oil prices, U.S. shale is kind of gradually stagnating. So there's not a lot of drilling activity. It's not really encouraging a lot of new investment. And of course, there's pretty fast depletion rates in U.S. shale. And so we have this kind of stagnant situation in the U.S. Um, Still kind of tepid demand growth globally, especially with the Fed as tight as they are, and other factors and tariffs and things like that. So a lot of uncertainty. As we kind of look forward a couple years, I generally think that, with U.S. shale oil no longer really growing at the pace that the market's become accustomed to, and as we potentially get those Fed cuts, maybe next year, for example, I do think we could see higher energy prices. But then in the meantime, any sort of flare up that is, hard to predict in advance, I still like to own it in advance of that. And so, in addition to my broader equities portfolio, I have that separate slice of energy so that I basically have some protection at least against unexpected crises without trying to overthink it too much.
Importantly, on energy demand, here's an article you wrote in March entitled, well, it's part of your newsletter, AI is impacting the investment landscape. You're separating data center AI from portable AI, i.e. robots, from an investment perspective. We now have reports from Bloomberg, this one's from Bloomberg, that highlight the additional need for energy coming from data centers. And in fact, they're projecting double-digit energy growth over the next decade. This is research from Bloomberg. What impacts does this have on the utility sector, and basically, how are you going to play this additional demand?
So a couple of things. One, it creates structurally more demand for electrical components, things like uh, um, uh, converters and various transmission type of equipment. Many of those companies, their backlog extends 3 to 5 years or more. Many of those parts are made in China, and so as kind of AI data center energy usage ramps up, it does put a lot of kind of strain on the grid. And one of the things I emphasize in that article is when people think of AI, they often just immediately also go to robots as though they're kind of functionally equivalent. But anything you do that's portable is way, way harder. Um,
Hmm.
and one kind of metric to think about is that the human brain, runs on something like 20 watts. It's less than an incandescent light bulb. And only in the past decade have the best supercomputers gotten to a point where they do roughly as many estimated calculations as the brain is estimated to do. And yet they do it on like 20 megawatts of power. So it's like a million-fold difference. Of course, they're way better at some uh, types of processing than the human brain. They're worse than others. But basically, trying to take something very powerful in that sense and then putting it into a portable robot that needs to run on, say, kilowatts of power is a very different dynamic. And so I still think that we're far away from portable AI matching humans in many capacities. But certainly in the data center sector, that's where we see basically a lot of AI agents able to do a significant amount of white collar work. And so I do think that over the next several years, there will be ongoing usage there. So that's a big uptick in GPUs, big uptick in electricity production. One of the things I focused on over the past several years is Bitcoin mining, because people had all these fears around Bitcoin mining potentially driving up prices or competing with other things. The funny thing is AI data centers actually do have some of those issues that Bitcoin miners, for the most part, didn't really have. And that's because Bitcoin mining and is super competitive in the sense that what they mainly compete on is getting the best machines and then getting the lowest electricity prices. And so they really can't compete with like urban electricity prices. They have to go out to the weird places where there's like stranded energy, or they have to buy energy at times of the day where nobody wants it, and then pull back during the more in-demand times. That's just inbuilt to their economics. Whereas AI data centers, because they have a lot more capex than Bitcoin mining, and they also have higher needs for like uptime and lower latency, they generally don't want to shut off the way that Bitcoin miners do. When possible, they want to be closer to population centers, whereas Bitcoin miners don't care as long as they have Starlink or something. And so AI data centers actually can compete with consumer electricity prices and basically drive up electricity prices in U.S. states, in other parts of the world. And so I do think that that will be an issue going forward. I do think it'll result in, on average, more natural gas demand, and potentially close the gap in terms of how much energy per cost you get from natural gas versus oil. And I also think it'll be long-term demand driver for nuclear as well.
So long natural gas and uranium would be your place.
Yeah, and I play that in terms of I'm generally long producers that produce natural
Ooh.
gas in addition to oil, whereas uranium I generally like to just hold the uranium itself, less so on the producers, and I leave the uranium mining stocks to specialists, given how challenging that sector can be.
Well, the human brain uses an average of 20 watts per day. I feel like talking to you, you use 25. So I don't know. That's just my impression. Let's take a look at what's going on now with tariffs. Since we've spoken, of course, there was the April 1st Liberation Day that happened after our last interview. And that was something that you did warn about, an escalation of tariffs. Since then, there's been a de-escalation, and now there's a deadline of deals coming up. Trump's tariff deadline is near. Here's a look at countries that have a deal and those that don't. I won't read you the full list, but basically the U.S. has managed to make only 8 deals in 120 days, including one with 27 member European Union nations. The deadline is approaching. It's August 1st. And back in April, Trump had claimed to have done over 200 deals. Um, the country has fallen far short of that, 120 only. Now, so let's assume, well, we don't know what's going to happen exactly, but we're speaking on the cusp of April, August 1st, so we'll find out. But let's assume that these deals do go through. Are we going to see a de-escalation of the trade war is my broader question.
We'll see. My concern right now for the next 2 months, I think we're in a vulnerable window where, like you said, we don't have all the information. There's a lot of uncertainty over the next couple months, and even the recent deals are still pretty high tariff rates compared to pre-April. And so back in April, there were all these tariff proposals, and the market freaked out. So equities sold off. Credit markets freaked out, basically higher spreads. And right now, estimated forward tariff rates are pretty similar to what they were back in April before the de-escalation, and yet the market is at all-time highs. Credit spreads are narrow. There's really little concern. Um, and so my general view is that there's more risk from tariffs than is probably being priced in.
Mm.
Um, and so, short of a major reversal, I do think that it'll be an ongoing friction against the U.S. economy and then particularly tariff-heavy sectors. Most analysis so far, like when you look at import prices, they're not down and they're measured pre-tariff. And so there's not much sign that foreign exporters are absorbing the cost, which means most of the tariff revenue is coming from some combination of American consumers and American businesses. There's also the fact that because tariffs were telegraphed in advance, many importers front ran the tariff, so they pulled in extra imports in quarter one, and that gave them some degree of a buffer against, as kind of the U.S. Treasury takes in. I think they reported over 150 billion in tariff revenue. Well, they also, because the importers pulled in a lot of products ahead of time, that gave them some buffer before they have to really kind of pass on costs to consumers. But if the tariffs do stay in place as they are, I do think that'll increasingly trickle out to consumer prices. And so most of this is at least a mild drag on the U.S. economy that somewhat offsets other things that are stimulating. So we're still running pretty large structural fiscal deficits. Nothing stops this train. That's still the background situation. But then that is, at least around the margins, somewhat offset by these structurally higher tariffs. And most of the deals we see, like we saw the one with Japan, where we place tariffs on them. Certain sectors are more targeted than others. There's generally headlines around, say, big investments that Japan's going to do, but when you dig into the details, mostly it's lending, which in many cases they're already doing. That's generally how this mechanism works: is that the U.S. runs these really big trade deficits with the rest of the world. They take the dollars and then they often buy our assets, or deploy their credit into our assets. And so I expect that to continue. But basically, I think that we have this new kind of annualized multi-hundred-billion-dollar tax that is roughly spread between American consumers and American businesses. Obviously, some sectors are more impacted than others. So we see, for example, Ford talking about the tariffs, but we don't really see Microsoft worried about the tariffs. And the reason that's notable is when you look at, say, the way these companies kind of operate is Microsoft is something like 100 times the market cap of Ford. So when we're talking about investing, we're talking about the stock market, it's all about Microsoft. It's not about Ford. But when we look at the broader economy or socio-political situation, Microsoft doesn't even employ twice as many people as Ford does, despite being 100 times the market cap. And so things that slow them down or impair them, while they might not be as spectacular in the near term on the stock market, they do tend to trickle out quarter by quarter as we see some degree of stagnant economic conditions. So I'm currently in the camp that views gradually decelerating U.S. economic situation. Uh, we don't have great seasonality coming up, especially by September in the stock market. So I do think that at least this 2 month window is a time for potential caution until we have maybe a little bit more clarity on what tariffs are going to look like going forward.
I just find it comically ironic that the key trading partners without a deal are NAFTA members. I don't know. I have no comment to that. Anyway, I want to ask you whether or not the tariffs that have already been implemented up till now have actually had a significant drag on the economy. Speaking of actual economic impacts, GDP, as you know, came in at 3% in the last quarter. Consumer confidence has been picking up, mainly due to, at least what I've been told, lowering or lowered inflation expectations. The inflation rate actually has risen a little bit up to 2.7% headline CPI, although it's still not, astronomically higher from the last print. And the Fed has not been forced to cut rates due to a pending economic shutdown. And so ultimately, back to my question, how concerned should we be about tariffs?
I would say moderately,
Mhm.
and more so economically than say the service sector stocks. Basically, this is where magnitudes are important. So basically, the fact that they brought in something like 150 billion in tariff revenue has to be compared with the fact that the U.S. is a $30 trillion economy, right? So while that's a non-trivial amount, it's not as though that's going to shut down the economy. In addition, some of that was buffered by the front running I mentioned, where companies were able to kind of pull in stuff ahead of time. So even as new purchases are coming with tariffs, they generally had inventory that they could still sell at prior prices. So I do expect to see some ongoing consumer price pressures from this. I'll be watching purchasing like import prices pretty closely to see to what extent, if any, foreign exporters are absorbing it. So far, not much. When we look at the recent GDP print, one of the things that complicates this is that tariff front running adds noise to the GDP figures. So if you remember, quarter one GDP was reported pretty weak. And that was negatively impacted by a lot of that import front running, because when you have a big uptick in imports, that puts downward pressure on GDP. And because we kind of have the hangover from that, where there's like less importing now, that's actually good for quarter two GDP. When you look at final domestic sales, the portion of GDP, that was markedly decelerating in quarter two. It wasn't a catastrophic print, but it wasn't a very strong print. Also, if you look at CEO confidence, it's been down significantly recently, which is not great generally for capex and hiring. And so overall, I wouldn't say there's massive red flags in the economy, but there's certain yellow flags. I've generally been in the pretty bullish camp through 2023 and 2024. And here in 2025 is kind of the first time in a while that I do have more concerns overall around both the state of the U.S. economy and stock markets. But that's still in the picture of we're still running very large fiscal deficits, which for many industries are a stimulus. So generally what I do is I look at things industry by industry, and I'm trying to determine, is that industry in a recession? Is it priced for a recession? Versus other ones that might be at risk for a recession but not priced for it. So I generally view sector by sector, industry by industry, rather than the whole economic picture.
I see. So if you were to assign a scorecard, would you say there are more sectors facing the risk of recession now than less, or is it roughly equal, or the opposite?
I would say most are not yet in recession.
Hmm.
Um, if you look at the real estate sector is in recession, it's priced for it. The financial sector that deals with it is generally priced for it as well, but I think they're holding up pretty well fundamentally. Uh, the part that I think is worrying is the labor market, which has not shown signs of cracking yet, but the flywheel could start to go negatively against it. So right now, no major red flags. Uh, but I think that as we've gotten past the buffer from front running of tariffs and the inventory, to the extent that these stay in place for another quarter or two, I'll be watching the GDP pretty closely because I do have increasing concerns around broader deceleration overall.
And that's after the front running of the tariffs. So yeah, we'll see what happens next quarter. Lyn, I want to move on now to Bitcoin and precious metals, which is the second portion of your investment thesis, starting with equities that you like, then Bitcoin and precious metals, finally with cash. We can skip the cash portions today. Bitcoin, you've made a presentation at the Bitcoin conference in Vegas. where the title of the presentation was called "Nothing Stops This Train Now." Just summarize your outlook for Bitcoin and why we're at this turning point that you've highlighted in some of the slides of that presentation.
Right. So the nothing stops this train thesis focuses a lot on the fiscal side, which I talked about, which is the U.S. is kind of locked into pretty high structural fiscal deficits going forward, especially on the spending side. Since that talk, the big beautiful bill has also kind of further locked in some of the things I've been talking about, which is, in any sort of investable time horizon, we're not meaningfully cutting Social Security, we're not meaningfully cutting Medicare or defense. Interest expense, even if we do get moderate short end Fed cuts over the next year, on average, interest expense is now, I think, structurally higher than what we got used to over the 2010s. And so overall, we're doing pretty significant deficit spending. It's only partially offset by the increased tariff revenue, which is again mostly coming out from Americans, either the consumer side or the businesses, or a blend of both, depending on what products in question. And so overall, that tends to run things pretty hot, at least. And that's where the breakdown is really important because if you're on the receiving side of the deficits, it's pretty big stimulus. On the other hand, if you're not on the receiving side of the deficits, you're more facing the tighter monetary policy. You're more facing the tariff revenues. You're kind of, out of luck, more or less. So it becomes very sector specific. And generally speaking, gold and Bitcoin, the benefit is they don't have margins to worry about. They're not subject to the tariffs. They're not buying things at higher prices and then trying to figure out what percentage they can pass on to consumers in the way that American businesses generally find themselves in right now. I think we're past the worst parts of this cycle's liquidity crunch, which was 2022. I don't really see that happening in the horizon. I mean, eventually we'll have something like that again, most likely, but nothing's really on the horizon for a major liquidity crunch. I generally think that market conditions globally are going to continue to be conducive for Bitcoin. To some extent, gold. We got a little bit overheated. It was one of the most overbought we've seen on the monthly RSI, which is why I got somewhat near-term concerned around gold. But structurally speaking, looking out 3 to 5 years, I continue to be quite bullish on Bitcoin and gold. And Bitcoin, I tend to follow a little bit more cyclically, and I still don't think that this particular bull market is finished yet.
I'm going to get your Bitcoin price projection in just a minute, so stay tuned for that. But one of the risks that I've heard regarding the Bitcoin, and in many regards, the crypto industry at large, but for Bitcoin in particular, the treasury companies now that are buying up Bitcoin en masse, including Strategy, including even miners like Mara that are hodling Bitcoin. A lot of these companies are trading at a significant premium to NAV. And what that means is that, well, we're bull cycle, obviously, but if the market reaches a point where this premium becomes exorbitant, people may start liquidating their shares in Strategy and or other companies. If, I'm not saying it will, but if the premium starts to become negative, which is to say the shares start trading at a discount to NAV, then some of these companies may be forced to offload their Bitcoin holdings in order to cover any liquidity problems. Is that a risk that you've thought about? Does it make sense to you?
It's something I've analyzed, and I've been a shareholder of MicroStrategy for the past 5 years. So I monitor them through the bear market last time.
Mm-hmm.
This one will be interesting because last time they did so primarily with convertible debt, which meant that their coupon payments were very low on a quarterly basis, and they would generally owe money all at once should that debt end up not converting. But they had extended the duration to something like 5 years. So they issued 5-year debt. So a 2-year bear market was not a problem for them, and they didn't really get that close to having to liquidate anything. This time around, I generally think they've improved their capital structure by shifting more toward preferreds. The only downside is that on a quarterly basis, they generally have more payments to make. So they have less lump sum risk that they used to, but they have more quarterly payment risk. But the way they've structured it is the way the preferreds work, and they have a couple different types. is that should they become very constrained in terms of capital access, they can suspend dividends on many of their preferred types without any sort of catastrophic Bitcoin liquidation or default scenario. It just kind of puts them in this situation where, they eventually have to address that. But during very painful parts of the market, they now have a pretty inbuilt degree of flexibility. Um, I do expect that as the cycle goes and more treasury companies come to market, uh, you know, given the sheer number of them, I don't think they'll all be well managed as MicroStrategy has been. And I do think that some of them will run into problems. Fortunately, I think they'll be on average, the smaller ones. So less kind of top level market risk. But I generally put the risk of a MicroStrategy liquidation as fairly low. It's something I think about and I analyze. But as long as they continue to manage themselves conservatively, I don't think that's a large risk. And I do think instead we'll see that generally more pop up in the weaker companies. And while that can give us accelerated bear market activity when it comes, it's really not that different than prior cycles, and maybe less so. So when you have FTX imploding like the prior cycle, right, and this kind of cascading liquidations, a lot of that was in sketchy markets. That's actually a lot of that's kind of been brought into more disclosed markets, and so it's generally more transparent. The risks are generally more laid out for the public to see. And while there's little pockets of excess or little pockets of risk, um, I would place that as kind of in line with normal bear market risks in the space. So that whole dynamic I view as contributing to the upside of this cycle. This cycle is certainly led by institutions, not really retail.
Mhm.
And I don't really view it as adding to the downside, even though some of those will unfortunately probably participate in the downside by getting over their skis.
Well, that leads me to to your outlook rather. The Bitcoin price has appreciated if you take the lows from 2020, late 2022, 2023. It's up roughly about 580%. From today's prices. It briefly surpassed 120K earlier this week. So where does this land us in the current Bitcoin cycle? How far along are we in this current cycle?
So one, I think that cycles can change shape over time. So
Hmm.
as we enter a more institutional phase, on average, I think we'll see a little bit less euphoria, but then potentially also a little bit less downward volatility, because you're not coming off of that level high of euphoria.
Hmm.
So when I look at metrics like market capitalization to on-chain cost basis, and so far we're nowhere near the peaks that we generally reached in say 2021, 2017, 2013, kind of those major multi-year tops. So this cycle has kind of been characterized by pretty strong upward moves, and then maybe a 7 month consolidation, and then another significant upward move, and then another 7 month consolidation. I think that's a healthier market overall. Currently, we're in another consolidation. I wouldn't be surprised to see it continue for a couple more months. I don't really have any strong view on near-term trading. Probably my recent orange flag or yellow flag was the rise of these altcoin treasury companies. That's kind of a sign of froth in the market. Combined with I previously mentioned maybe some of these economic deceleration risks over the next couple months. So I wouldn't expect to see a little bit more consolidation in the months ahead. But I do think we have probably at least another stair step up, like we've seen a couple of these this cycle, hopefully more than one. But I still think we're headed higher in terms of this kind of upward move and then consolidation and upward move consolidation. I still think we have more fuel this cycle.
One of the well, you have a lot of interesting charts from the your Bitcoin Vegas presentation. This one here, gold versus real rates, and I'll apply the same analysis to Bitcoin. So a decoupling of real rates to gold. Now, I think is this inverted? No, it's
Uh,
not.
the, the real rates one is
Yeah.
inverted.
Yeah, because there's been a historically there's been a negative correlation between gold and real interest rates, which makes sense conceptually. Ever since the beginning of 2022, 2023, we've seen this decouple, and this decoupling has not stopped at all. Is there a fundamental shift in the paradigm between where the paradigm of gold investing?
I do think there's a fundamental shift, and people said the same thing around Bitcoin. They were like, Bitcoin's a zero rate phenomenon. It won't do well when you have high rates, and here we are at at high rates and Bitcoin six figures, and gold, comfortably well over 3,000. Um, what changed was that we entered fiscal dominance. And so when you have pretty low public debt, and most of the money creation is coming from bank lending, when you raise rates, you generally slow down bank lending at a bigger degree than you blow out the deficit. On the other hand, when you have over 100% debt to GDP on the public sector, and most of the inflation is coming from monetized fiscal deficits, not from excessive bank lending. When the Fed does what they're doing now and they raise rates and try to keep them high, they actually blow out the fiscal deficit by a bigger number than they slow down bank lending. So they don't, for the most part, they don't greatly slow down total credit growth in the way that they're trying to. So basically, when they sharply raise interest rates in 2022, that temporarily brought everything down. But then as soon as we started to get some of your treasury offsets, we started draining the reverse repo facility. We were not really, even though the Fed was remaining hawkish around the margins, a lot of conditions were still improving at that point. And that's generally a sign of fiscal dominance that even high rates don't really do what they used to do in terms of slowing things down. Sometimes they just add fuel to the fire. And so I think that's structurally what changed this cycle. And I think that's a more persistent regime that we're in now. That's not even a near-term thing. That's just kind of structurally the environment that we're in now. And so there's still be correlations where if the dollar goes through a strengthening period as it has, in recent weeks, that can put downward pressure on gold and certain other assets. But in the grand scheme of things, I think that correlation, that interest rate correlation, is severely reduced now, and it's more about what's happening fiscally. How independent is the central bank perceived to be, and factors like that more so than just that interest rate correlation.
Are you more bullish now, Bitcoin, than gold, or vice versa?
In terms of raw return potential, I'm more bullish on Bitcoin, and that's worked out well for the past 5 years. Just because gold's a 20 trillion plus asset, Bitcoin's a 2 trillion plus asset, and I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is because I've been a bond bear, I basically said if you take a 60-40 portfolio and think how can I improve it for a period of fiscal dominance? Well, one, you can take out some of the bonds and replace that with some gold, for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as different, replacing different parts of the portfolio. I think gold is more of it's more of a competition for bonds, and Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities.
This is a scary chart. We talked about the labor market briefly earlier. This shows fiscal deficit as a percentage of GDP in the blue line and the unemployment rate in the red line. And we've seen an unprecedented break of these two data sets. The fiscal deficit as a percent of GDP is now at or near 7%, while the unemployment rate is closer to 4%. What does this chart imply? Are we going to see this sort of alligator jaw snap back? And if so, which line is likely to move to convergence first?
So I don't think it'll snap back. And to the extent that it snaps back a little bit, it's potentially higher employment. But
Hmm.
basically, the biggest reason for that, number one, is demographics. So we started to enter an older demographic period, and because our economy has a pretty extensive entitlement system, that means more people drawing from Social Security and Medicare than paying into it, and so that increases our deficits even at a time when we have low unemployment. And in addition, we ended a 40-year structural period of declining interest rates. And so for many years, we had rising debt to GDP, but that was offset by falling interest rates. So it kind of kept interest expense manageable. But now when we enter a period, even if interest rates are not structurally rising, if they're just kind of in a choppy range now. So if you're not falling from like Volcker era all the way to zero, if instead you're just kind of bouncing between 2 and 5 for the foreseeable future, let's say, you no longer have that offset, even as you're running pretty significant deficits. And so the combination of higher interest expense and more seniors drawing from the entitlement system, that puts just more structural strain on fiscal deficits. And to the extent that we do get a uptick in unemployment, generally speaking, you should expect that the fiscal deficit to also probably widen to some degree. So it's pretty hard for those alligator calls to close anymore, and that's partially why. I mean that's fiscal dominance in a nutshell. That's basically that is a different investing environment than people are used to for the past 40 years.
And so, if nothing stops this train in this particular metaphorical case being the fiscal deficit widening, well, could Bitcoin be the only thing that moves along with this train, or do you have other assets in mind that could benefit from this shift in a paradigm here?
So I don't think it's the only thing. I think it's one of the fastest horses available at scale with liquidity. So structural bull on Bitcoin, but also, I mean, gold over bonds is generally a beneficiary of fiscal dominance. Um, Equities at reasonable prices is also generally a beneficiary of these situation. I talked about strategy, formerly MicroStrategy. A company that holds Bitcoin which is scarce, and then they issue various credit instruments denominated in the currency that's, we're running away in terms of fiscal dominance. So they put their liabilities in things that are debasing and their assets in terms of things that are scarce. And as long as they manage that conservatively through the various ups and downs and volatility cycles, they benefit. Even part of the reason why traditional equities can do well is because a lot of equities like locked in 5, 10, 20, 30-year bonds at super low rates, um, and bought back shares, and they still have a lot of those bonds outstanding. So their liability side is locked in and gradually getting inflated away. And the ones that have pricing power can keep ratcheting up their prices, um, and keep doing pretty well. So generally speaking, anything that has some degree of scarcity, whether it's an economic moat for a business or pricing power, or it's literal scarcity like gold or Bitcoin, is generally well positioned for fiscal dominance outside of kind of localized overbought bubbles that show up from time to time. And then anything that can attach a short of fiat currency to those things generally adds fuel to the fire as long as it doesn't get over its skis.
Okay, final question. I'll let you go. The FOMC meeting revealed two dissents from Waller and Michelle Bowman. Incidentally, both are considered runners-up to replace Powell, should he either be fired or resign or after his term ends. In either case, we are probably expecting the next Fed chair to be more favorable to Trump's demands for a lower interest rate. How do you see, basically, this dynamic playing out? Who is likely to replace Powell, if you have an opinion, and what's going to ultimately happen to the Fed funds rate?
So I don't have an opinion on who. I have an opinion that it'll be more of a dovish, more of a accommodative
Hmm.
appointment, based on the president and the current makeup of Congress. Um, and my general expectation is that, by 2026, we'll probably have lower average interest rates. It's important to note that the Fed chair is not a unilateral decision maker. It's a committee.
Sure.
Um, but overall, I think basically we'll be in a generally more dovish position. Um, Long end rates, like I said, maybe sideways. That's more of a trading question of what's going to happen in any sort of 3 to 6 month period. But it's important to keep in mind, and generally in recent kind of discourse, I see this often mixed up, that just because the Fed cuts rates doesn't necessarily mean that, say, mortgage rates go down or long end treasury rates go down. And so you could see them cut rates and the yield curve steepens just by them staying roughly where they are. And so my general base case is mildly lower short-term interest rates over the next year or two, um, flat and choppy longer in rates, depending on what happens with tariffs and what happens with any sort of unexpected shocks along the way that I'm sure we'll discuss in later discussions we have together. There's never kind of a shortage of things to talk about. Um, uh, one of the, I think the key things worth pointing out is that we're probably not going to get a really big housing refinance cycle this time. So generally speaking, when you do get a rate cutting cycle, especially when longer end rates do go down due to some degree of kind of economic slowdown, one of the silver linings is that homeowners can refinance their mortgages and basically get a free lunch. And the problem is that I don't think we're going to get a lower low in mortgage rates, which will generally limit how much refinancing volumes happen. And it'll mostly be limited to people that unfortunately kind of locked in higher mortgage rates, kind of in 2022 and beyond. And those people can get potentially a little bit of a, uh, ability to refinance, but that'll be a much smaller burst than we're used to. And therefore, especially combined with tariffs, I think it'll put some pressure on the consumer. So I generally think that we're in more of a malaise going forward. So it's not doom and gloom, um, but until I see signs that say otherwise, I think we're in a little bit of a pretty range-bound period in terms of economic performance. And then my guess would be also top-line equity performance, but we'll see.
Excellent. Thank you very much, Lyn. I can already see that you're using up close to 30 watts of power, so we'll let you go here. We'll touch base in a couple months. Where can we follow your work in the meantime?
They can go to lynalden.com, or they can check out my book Broken Money on Amazon or elsewhere.
Okay. And congratulations once again on EgoDeath Capital. And we'll keep tabs on the progress there. So thanks again, Lyn. Make sure to follow Lyn Alden in the links down below. And we'll see you next time. Thank you.
Thank you.
Thank you for watching. Don't forget to like and subscribe.